Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Nextracker stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 8 billion market cap. They're trading at $56 a share and they have 146 million shares outstanding. Nextracker is an energy solutions company that provides solar tracker and software solutions for utility scale and solar projects in the US and around the world. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a little under 100 million in 2021, negative in 2022, back to positive 100 million in 2023. Look at their 2024 free cash flow. It went up 300% from 2023. They did complete their 2024 fiscal year. They're actually working on their 2025 fiscal year currently. And pretty good margin, 17%. Free cash flow margin is free cash flow over revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's always positive. Their best ever in 2024, $500 million. Good margins, 20%. Revenue is a sales for the company, and that goes up each year from 1.2 billion to 2.5 billion. This company looks a lot better than Sunrun. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4. That's 8.4 billion. We discounted the numbers back to today using a weighted average cost of capital. We get a value of the company of $7.4 billion. We divide that by 146 million shares. And we get a calculated stock price of $50. They're trading at $56, so they're trading at 11% premium. It's a sell according to the model. There are 26 companies in the same industry as Next, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx because what they do is a bit different than most of the other solar companies. A very low debt to equity ratio. For every dollar of equity, they have 10 cents of debt. They're generating the most free cash flow out of anybody on this list. They rank third in market cap, pretty far behind number 1 and 2. They're trading at 7 times book value. Their PE looks good. It's between the median and average, trading at 17 times earnings. They have a good price to free cash flow, at least good relative to the other companies in this industry, and they're trading at 3 times revenue, which is worse than the median average. They generate $2.5 billion of revenue. If you put $10,000 into this company when they started trading, you'd be at $18,000 today. That's an 82% return, a 57% annual return. Let's look at their 10K. This shows us 22, 23, and 24. Revenue goes up each year from 1.5 billion to 1.9 billion to 2.5 billion. Really nice growth. Let's see if they give a breakdown of the 2.5 billion. Here's a breakdown of the revenue by location. Of the 2.5 billion, 1.7 billion in the US, 800 million in the rest of the world. The country with the second most revenue is Brazil, a little over 200 million. Their revenue has gone up more in the US as a percent. It went from 62% in 2022 to 68% in 2024. Revenue has gone up 30% each year. From 2022 to 2023, it went up 30%. It went up 31% from 23 to 24. Cost of revenue didn't go up nearly as much. It went up 23%, then 4%. So that means their gross margins are improving dramatically. Look how much their gross margins have improved. 100% from 22 to 23, nearly doubled. And then 180% from 23 to 24. They're doing a good job at managing expenses. SG&A is 184 million. That almost tripled from 22 to 24. And then you have R&D, 42 million. That almost exactly tripled from 22 to 24. Their operating income looks great. It went from 66 million to 587 million. In 2022, they spent 34 million of interest on their debt, then 1.8 billion, then 14 billion. That's a great way to grow and scale using debt. Net income for 2024 is $500 million, up from 50 million. Did you ever notice as you get lower on the income statement, the growth gets more exaggerated? For example, their revenue grew 31% from 23 to 24. Their gross profit grew 180% in that same time period. Operating profit nearly 250%. Net profit over 300%. So as you go down the income statement, the growth is more extreme. That's not always the case, but if a company's doing the right things, that should be the case. Let's look at the balance sheet. 1.8 billion of current assets, 900 million of current liabilities. So the current ratio is a 2. Current ratio is current assets over current liabilities. They have $500 million of cash, a lot more than last year of 130 million. It looks like they sell a lot on credit. They have almost 400 million of accounts receivables. Contract assets is similar to accounts receivable, also 400 million. They have 200 million of inventory. Their total assets 2.5 billion, up a lot from 1.4 billion. They have a lot of goodwill, 265 million. Their goodwill comes from the 2015 acquisition of Nextracker and the 2016 acquisition of Brightbox. Brightbox was acquired by Flex on behalf of Nextracker. In 2015, Flex acquired Nextracker for $330 million. Flex has a market cap of 12.8 billion, Nextracker 8 billion, so that was a great acquisition. It was announced about 1 year ago that Solar Tracker has split from the Singapore company Flex. Flex did control Nextracker for 8 years, but they did split apart. Now they're separate entities. So if you own Flex, say in 2018, after the split last year, you would have received 0.17 shares of Nextracker for each share of Flex you owned. Let's just pretend you had 6 shares of Flex stock. After the split, you would have kept your 6 shares, but then you would have received 1 share of Nextracker. Let's go back to the balance sheet. Their total liabilities 1.5 billion, up from 900 million. They have 456 million of accounts payable. This is how much money they owe others when they buy on credit. They have $500 million of TRA, tax receivable agreement. This is from the split with Flex. They talk about it right here, tax receivable agreement. The company has recorded a liability of 400 million. That represents 85% of the estimated future tax benefits subject to the TRA. This is in connection with our IPO, exchanges of Class A common stock or cash and payments made under the TRA. So to simplify it, a TRA is when a company agrees to share tax benefits with another company. Assets minus liabilities equals equity. They have 1 billion of equity. They raised 4 billion from selling their business. They lost 3 billion from running their business. Let's look at the statement of cash flows. The first section is operating cash flow. Negative 147 million in 22, positive 100 million in 23, positive 400 million in 24. So that looks really good. They don't need to spend much in CapEx, only 6 million. They added 552 million of Class A stock, which was purchased by Yuma. Yuma was part of Flex. Now Yuma is part of Nextracker. So in their financing section, they had a cash outflow of 78 million. Let's look at a stock on Simply Wall Street. Its last price 56, 8.1 billion market cap, up 1% in the past week, up 38% in the past year. They started trading in the beginning of 2023 after the split from Flex. It looks like they started out at about $30 a share. And the stock has pretty much only gone up since they IPO'd. It peaked at 60 in March, then it came down to 43, and it's been growing a lot. It's getting close to its all-time high. Simply Wall Street values the company at 70. They say it's 20% undervalued. 27 analysts priced this stock at 61. Their revenue forecast for 2025 is 2.9 billion, 2026 3.2 billion, 2027 3.6 billion. The free cash flow forecast for 2025 is 385 million, then 477 million, then 526 million. Their revenue went from 660 million in 2019 up to 2.5 billion. Pretty impressive growth. This red line at the bottom is their debt, and they had no debt for a number of years. They added some in 2023, but their equity looks really solid. It goes up a lot each year. And they do have enough cash on their balance sheet to pay down all their debt. 470 million of cash, 147 million of debt, and almost 1 billion of equity. The CEO's salary is a little under $500,000. Total compensation 9 million, tenure as CEO 1.3 years. In the past year, there's been a couple insider sells, no buys. Pretty much all the companies owned by institutions. The biggest shareholder is Fidelity, then BlackRock. AllianceBernstein owns 1.6%. Senegon Asset Management, 1.1%. The Swedish investment bank, Handelsbanken, they own 1%. The large Australian investment bank, Macquarie, a little under 1%. Their employee count went from 400 to 1,100. And the ticker trades on the NASDAQ and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.